was the dawn of a new era. In 1994, amid the birth of a new democracy, MTN began its journey. From modest beginnings, we envisioned a connected Africa. Today, we're grateful for the opportunity to connect millions across the continent, from bustling markets to remote villages, fostering connections that transform lives and communities. Guided by the belief that everyone deserves the benefits of a modern connected life, we've made it our goal to drive digital and financial inclusion, giving people in the communities we serve dignity, hope, and opportunity. Our strategy, Ambition 2025, is a testament to this commitment. We're humbled to have helped generate economic value, investing significantly in infrastructure and the communities we serve, creating opportunities across the continent. As the demand for data continues to soar, we are dedicated to expanding and enhancing our network, ensuring a world-class digital experience for the markets we serve. We believe in the power of technology to uplift communities. Working hand in hand with our partners, we champion initiatives that promote digital and financial inclusion and empower the next generation of African leaders. Our success is irrevocably tied to the progress of the nations we serve. Together, we create jobs, develop local suppliers, build digital skills, and support essential services like education, healthcare, and infrastructure. We understand the importance of preserving our planet for future generations, and we're committed to reducing our environmental impact and achieving net zero emissions. Our journey is a testament to the power of partnership and shared progress. We're grateful for the trust and support of our customers, employees, host governments, and partners across the continent. Together, we've overcome challenges, embraced innovation, and pursued a better tomorrow. We are privileged to have contributed to Africa's digital transformation, enhancing communication, providing access to information, and fostering economic growth. By bridging the digital divide, we're helping to unlock Africa's boundless potential and create a more prosperous and inclusive future for all. As we celebrate 30 years, we look back with gratitude and ahead with unwavering belief in Africa. Our journey is testament to the power of partnership and shared progress and reaffirms our commitment to growth, innovation, and Africa's digital future. It's been 30 years of doing, and we are not done yet.
Good afternoon, ladies and gentlemen. My name is Tato Motlanthe. I look after Group Investor Relations at the MTN Group, and it's my privilege and my duty to welcome everybody to our financial results for the half year ended the 30th of June 2024. So I'm delighted to welcome our valued investors into the MTN Innovation Center, those who have come in person, as well as the MTNers in the house, as well as across all of our markets, as well as everyone who's dialed in on the various platforms. So we're live on CNBC Africa, we're on a webcast, we're also on the MTN YouTube and LinkedIn channel. So welcome to everybody. So let's just start off with the usual housekeeping items. First and foremost, you should be seeing our standard disclaimer and safe harbor slide, and that just covers the presentation for today. And then those of you in the room, you'll be glad to know that the emergency exits have not changed. There's one to my right and one to the back of the auditorium. And then just for your convenience, we do have the Wi-Fi details that should come up on screen now, yellow events. We've also got a QR code which you can try and scan very quickly as I run through, and that should give you a download of the presentation pack for today. If we go on to the next slide, we've got the social media platforms. And if you're tweeting, you can use the hashtag MTN Interims 24. And the Twitter handle or the X handle for MTN Group is @MTN Group. If we move forward, and I think in terms of the last thing before I get into celebration of our 30 years, we do have refreshments for you, for those who have come in. They'll be in the usual place again, just outside of the auditorium. So, I think as we commence today's proceedings, I think it's important to acknowledge a significant milestone in MTN's journey. This is our 30th year in existence. And really, it's 3 decades of sustained growth, innovation, and creating value for all of our stakeholders and shareholders. And really, just in terms of building on this legacy, the interim results that we present today are really here to show you and offer perspective on basically our recent performance, but also how we expect to evolve the strategy going forward. So we're very pleased about that, and I think we'll address the challenges, but as the opportunities as well. I think it's become a bit of a theme over the past couple of results, that where there are challenges, there are opportunities as we navigate the challenges that we faced in half one, as well as how we create value for long-term success. So with that in mind, let's just look at today's agenda. It will be the usual running order. I'll shortly welcome our Group President and CEO, Ralph Mupita. He will run through some highlights, as well as an overview of our operational and strategic review. He'll be followed by our Group CFO, Tsulu Molefe, who will give us an overview of our financial performance. Ralph will then just come back to give you a perspective on how we think about the rest of the year and beyond. So just afterwards, we do have questions. Obviously, those in the room can ask from the floor. Those who are on the webcast can ask questions through the platform, which I'll read out. And obviously, we are scheduled for about an hour and a half in terms of this presentation. We will cut off at about 5 o'clock local time. So without further ado, let me welcome our Group President and CEO to the stage, Ralph Mupita. Thank you very much.
Tato, thanks very much, and my own welcome to all who have joined us here at 14th Avenue. For those at 14th Avenue you'd have seen as you came into the building, we're celebrating 30 years of MTN. I'm sure you saw the display of the phones that started this mobile revolution in the 90s, all that the various brands that were there that we don't see anymore. Nokia's the 33010, which was a favorite for many. It's up there in display. It tells the story of the journey that MTN has been on. And as Tato said, this is a year of long celebrations of MTN playing its role in connecting Africans to the internet. We now have 288 million subscribers every day using the MTN network. I saw the very first business plan of MTN for 1994. The idea was we were going to have 10,000 subscribers. 10,000 subscribers was the business case for MTN, and today we sit having connected 289 million subscribers. I also extend welcome to all of our various stakeholders, investors, the media, broader stakeholders who have joined us today to listen to the results that Tsulu and I have the pleasure of presenting on behalf of the staff who've done a sterling job in executing on our strategy amidst a period of a challenging macroeconomic backdrop that Tsulu and I will take you through. Earlier today, we released the SENS, the stock exchange announcement, which gives a lot of detail. I trust that you've started to work through it. We also released a joint announcement between MTN Group and MTN Zakhele Futhi. MTN Zakhele Futhi is a key component of MTN. It underpins our transformation, our triple BE level 1, which both Group and SA have enjoyed over several years. And we're making a proposal to our shareholders at an EGM that we anticipate will be held around the 14th of October to extend the scheme from the 8 years to 11 years ending 2027. More of that between now and the October 14th EGM date. Tsulu and I will anticipate over the next 50 minutes or so to really land 6 key messages. The 6 key messages that we want to leave in terms of how we've assessed the performance and the outlook. The very first point is we are seeing very strong commercial momentum within our business. If you look at how we're adding subscribers, how we're seeing usage in the core connectivity business, we're seeing very healthy growth there. In the fintech business, we're again seeing very healthy growth in terms of the transaction volumes that we're seeing. Those are up 9.7 billion transactions in the period. We're seeing good monthly active usage, and then we're also seeing the merchant ecosystem expand, and it's expanded by almost 50% to 2.3 million merchants across. And so for both data and fintech, which are the big growth drivers for the business, in the medium to longer term, we had pleasing service revenue growth, data 21% and fintech at 27%. So we make the first call out that there is as underlying strong, sustained commercial momentum across our businesses. The second point we make is that we're seeing a pleasing continued expansion of the fintech ecosystem. I mentioned earlier on the growth in transaction volumes. We've seen also very healthy growth in transaction value across the platform. What is a standout in this reporting period is really been about the growth of the advanced services. We've spoken about basic services and advanced services. The advanced services are around remittance, payments, and bank tech. Those have grown very strongly. In aggregate, advanced services grew at 58% year on year. So the case for the fintech business and its transformation is coming through in the results. On other strategic initiatives, we said we would do certain things. We have done them. The first is really around localization. We have localization requirements across a couple of markets driven by regulatory requirement. So in Uganda, the regulatory requirements are that there should be 20% local ownership. We've met that regulatory requirement, and the last further sell down of MTN Uganda yielded gross proceeds of about R1 billion equivalent, and we've taken that regulatory compliance. In Ghana, we're looking to meet two very different regulatory requirements of local ownership. For the core GSM business, there's a 25% local ownership, but because we have a substantial fintech business, the Bank of Ghana is looking for 30% local ownership. And again, we've made good progress there in the period, further sell downs there, yielding about 700 million of gross proceeds. So we have about 2 percentage points of further localization to meet the fintech requirement as well there. So on localizations, good progress. We said we would look to simplify the business. We have the framing of portfolio optimization. In the half, we concluded the exit of Afghanistan, orderly exit to an M1 associate vehicle that we sold, the business. And we announced post the period end the exit of Guinea-Bissau. We have been in talks with Telecel to exit Guinea-Bissau and Guinea-Conakry. Progress now made on Bissau. The dialogue on Conakry with Telecel and the authorities in the market, continue. We also made a statement that with the MasterCard transaction, what we want to do is try and bring in the commercial benefits, particularly on issuance and acceptance. We're beginning to roll out across 7 markets. That partnership going into Q4 and early part of next year, we should see the results of that partnership really driving forward the advanced services that we spoke about. So on some of the key strategic initiatives, we're seeing good progress. This resilient underlying performance has been masked by some macro challenges, to be clear. And those macro challenges come into our reported results. Now, Tsulu will take us through in quite a bit of detail, but there are 2 main drivers that are dampening the very strong underlying performance in this period. The first is the significant and sharp devaluation of the Naira. The Naira was order of magnitude before May last year, around 460. In June, there was liberalization of exchange rates, and the Naira went to about 770, closed the year at 907. And we had quite a lot of volatility in the Naira, particularly between January, February, and March. And we've seen the Naira average across the first half at about 1,500. Those currency shocks have impacted our reported earnings, as you'll see a little later on. But actually, the underlying growth in Nigeria, when you look at the top line, how we are building up the customer base, etc., remains very strong. So Naira devaluation in particular is the first call out. The second call out is Sudan. In Sudan, as we are seeing all the geopolitical developments, Sudan, for us at MTN, is a very worrying situation about a humanitarian crisis that's unfolding on the continent as we sit here today. We have many Sudanese people displaced from their homes. The war is intensifying in a place like Khartoum, and many people have moved into different areas, and actually many people are in their diaspora. Our own management team are managing that business out of Cairo. We have some of our staff also out in Dubai. So we had a period of in March and in April where the network was actually down. We've started to restore the network, and as we exited July, the revenue growth that we're seeing now exiting July, having restored the network, is where we were in January before the intensive fighting that was in and around Khartoum. So Sudan had an impact in our results, both at the top line level, voice and data. It shaved off some of the kind of organic growth we would normally see, but also we brought in an impairment of about 3.8 billion rand that Sulu will talk to. So those were the big macro challenges that are masked a strong underlying operating momentum that we've seen in the business. The fifth point, financial flexibility and resilience. We've done a lot in the last couple of years to really put the balance sheet in good shape. Many of you remember where the holdco balance sheet was 80% dollar-denominated debt. It's now about 22%. So we've been able to use the proceeds from the upstreaming to change the mix of the debt that we hold at the center, giving the business more resilience, less mismatch of our debt profile versus the earnings that we had. And to Tsulu and the team, a job very well done in changing the debt mix. We closed off the period with holdco leverage at 1.6 times, so just slightly above our target of 1.5 times. But I think the really important point is the debt mix has changed and much more healthy, and we're able to do a decent amount of cash upstreaming in the half, 6.5 billion rand, and we cleared some of the outstanding dividends from Nigeria, H123, that's been cleared as part of the 6.5, and Sulu will give us more detail. Final point, encouraged by the underlying operational momentum and our ability to manage some of the headwinds that we're seeing in the near term, the board is comfortable to maintain the medium-term guidance. The board still anticipates a 330 cents dividend for FY 2024. We have an annual dividend guidance now, so we don't have an interim dividend. So that, as in more recent periods, the final declaration will be in March of next year. Under current outlook and assumptions and our own solvency and assessment, we feel comfortable with that 330 cents going forward. So just a couple of the commercial highlights that I spoke about at a high level. We see data traffic grew very strongly in the period. We're now carrying about 9,000 petabytes of data across our network. That's a data traffic increase of about just under 36%. Active data users are now at 150 million, and monthly usage has moved up very strongly now. It's about 10.5. Smartphone penetration, which is not on this slide, is now we're almost at the 2/3 of our customers are now on our network. Some of them using smartphone data regularly. Some we still need to encourage, to start using data more regularly. And then on the fintech, similar directional progress of strong transaction volumes. The active merchants, as I mentioned, 1.5, prior period 2.3. Ultimately, you want ubiquity of merchants, so our customers can go anywhere and they're able to transact. So that's a KPI I watch very closely, because it is about the democratization of financial services and ubiquity of what we deliver as MTN. So pleasing progress both on data and fintech, the underlying drivers of growth in the near to medium term. Sulu will come through and give us more detail on the financials, but just a couple of key call-outs. On constant currency service revenue at 12.1, Sulu will show you that actually when we strip out the effect of Sudan on constant currency, that 12.1 goes to 13.6. Now, a big compression in the service revenue has been actually that Nigeria used to be a much more significant part of the constant currency formula. So if you take out the translation impact of the Naira, i.e. kind of normalize it, actually service revenue growth was about 18%. So it speaks to the point that I said underlying growth remains pretty strong. And as I mentioned, data and fintech service revenue. The currency effects and the ongoing conflict in Sudan, that's really had an impact on the earnings side. So we see a compression on headline earnings of about 50.5%. Tsulu again will try and give you a normalized view, which looks to strip out the effect of the Naira devaluing so sharply and in such a large quantum. And it gives you, again, a better underlying performance sense of how the business is actually doing organically. I spoke to the balance sheet elements, again, fairly resilient, operating free cash flow under 10 billion, and adjusted ROE at 20%. Coming into the operational review of the markets, and maybe starting with South Africa as usual, a couple of key call-outs. The performance in H1 is a tale of two quarters. The first quarter had some load shedding as we were completing our own network resilience investment. And the second quarter, we were able to exit Q2 actually with network availability above 99%. So to Charles and the team, who've done a significant job much of last year and the first quarter of this year, we can say the investment in network resilience has been completed. We spent in total 4.6 billion rand towards ensuring that our circa 13,000 sites all have battery backup power with enough autonomy. We're seeking 6-8 hour autonomy. And in some of the sites, particularly the hub sites, we have further backup power in terms of gensets where we are able to. We're putting solar on rooftops to have a mix of backup power. And obviously in the second half and moving into Q3, load shedding has not been an issue for us with the Eskom grid kind of holding up steady. But the load shedding story and the issues around the network having availability issue because of power, I think Charles and team have done a sterling job in terms of dealing with that actually in about 5 quarters from a standing start. The other call out in the market context has really been about inflation. Inflation relatively has remained a little bit elevated, but I guess when you look at it relative to other markets, it's quite moderate. The key call out market is the consumers under pressure, particularly in the lower end. I think you see it in some of the numbers, particularly around our prepaid business. We're seeing a bit of pressure there. Charles will talk about, if you have any questions around that, Charles is in the room and can answer that. But our key activities were really around investing in the network. So we put 4.6 billion rand of capex in the period into the network. 1.6 of that is the last stub of the network resilience. So as we go into H2, all the capex is really about network capacity and coverage as we go along and picking up our 5G investments, which were pulled back a bit as we had directed that investment towards resilience. So 3 billion purely on network and IT. We worked on price optimizations in the period. In February, we brought some tariff increases to postpaid. So that was February. We've looked at our prepaid portfolio, firstly looking to simplify it, but also as we exited end of H1 in June and in July, we started to look at some bundles and looking at price optimization on the prepaid. And so the effects of that are not anywhere in the numbers for SA. You'll see that in terms of H2, and I would caution that you'll see more of it coming out of in Q4 rather than Q3 as we're looking to optimize some of those prepaid bundles. And as I said, Charles is here to take questions around that. The service revenue development in South Africa has been encouraging. Q1 was 3%, Q2 3.6%, so a nice progression on service revenue there, so that we end the period at 3.3%. All bearers doing well. I think the pressure we're seeing is more around prepaid, where we're seeing the consumer there a little bit under pressure. In terms of Nigeria, you'd have seen a detailed presentation from Carl and the team on the Nigeria results. So I'll just pick up the key highlights. 3 main points on market context. First is the devaluation that I mentioned, a very sharp devaluation, particularly in Q1. It stabilized somewhat, and we'll talk about that in the outlook, how we see that. Inflation has picked up, though the latest inflation prints are suggesting it may have peaked. It seems the efforts of the central bank to tighten rates, is beginning, to work. But elevated inflation has been a big part, and we see that in our cost base. You'll see the analysis from Tsulu. And we had to navigate the NIN SIM registration. We took a zero tolerance on subscriber registration and actually early terminated many of our subscribers. And the deadlines have been extended somewhat. But those were the three main market context issues that Carl and the team had to contend with in the period. What have we focused on? We focused on what we call the 5-point plan internally, which are the set of initiatives that are going to improve the negative equity position that the business found itself as at the end of the year. And those 5 being, advocating for a tariff increase, through the industry body, renegotiating our tower contracts with IHS and ATC, looking to reduce the LCs that we still needed to pay down. We spoke about expense efficiencies, and we reduced CapEx. So in terms of what we achieved in that 5-point plan, I think there are a couple of ticks there. LCs brought down, it was about $400 million at the end of last year. That's all kind of 100 million and lower as of the half, so cleared the balance of that. So good progress there. We've managed to keep the CapEx envelope relatively tight. We've had the ability to have radio planning to manage some of the demand that we're seeing. As you can see in Nigeria, data grew at 42.6%. Data growth has been very, very healthy in Nigeria. As I mentioned, the underlying trends there we're seeing are very, very pleasing. So we've managed a very tight CapEx envelope. But most importantly, we spent a big chunk of the time engaging with ATC and IHS to try and find win-win-win solutions in terms of these tower contracts. And to Carl and the team who spent a big part of the last 7 months, to and fro. These are very complex agreements to work through in kind of normal circumstances. My thanks to the team for having made a substantial amount of progress. Just talking about the tower agreements, we announced the successful conclusion with ATC and IHS with our trading statement on the 7th of August. Now, I know that the market, we have many on the buy side and the sell side who want a lot more detail. The first thing, these contracts are confidential. And there are many questions you like to ask us, and we won't answer them, not because we don't want to or we don't have the answer, but because they are confidential. However, what we're trying to do here is to give you a frame of what the impacts are without breaking any confidentialities. And so I'll just share some of the salient features, what was before and after, and then I'll follow up with the slide on pro forma financial effects. And as I said, these are confidential agreements. There are many questions you like to ask, and we won't be able to answer them to honor the confidentiality. But the salient points are as follows. With IHS, we've signed binding terms that are effective the 1st of April 2024. We have escalations. The escalations have reduced with caps in them, particularly the Naira inflation. There's a cap on the Naira inflation. We spoke a lot about this in the past, that we wanted to have tower arrangements that were not technology-based pricing, but more about space and power. So all the upgrades are now going to be about moving from technology-based pricing towards space and power, which is a lot more conventional. With space and power with ATC. We actually have space and power with IHS here in South Africa. And there are some additional discounts that post-2025 with IHS will be able to benefit from. Those discounts go from 2025 all the way up to 2032. The absolute amount of those discounts, you can see we haven't put them, but we didn't have those discounts before. And the base rate at which we're converting previously dollar-denominated expenses is 1,050. That's the base rate at which that conversion happens on the 1st of April. And you can well imagine that the rates 1 April would have been a number which was prevailing in 1 April. For those who pull out your calculators, that number you'll see was more like 1,500. So there's a bit of a benefit there that helps us in terms of the economic profile. The bottom part of the chart, what we try and illustrate is the before and after in terms of mix of US dollar denominated, Naira indexed, and Naira diesel indexed. Naira diesel is at the pump, is in Naira, so it gets invoiced. And obviously, it will have some correlation to crude prices, which are dollar denominated, but at the pump in Nigeria, it's in Naira, and there's a base rate. So what you can see clearly there is that before, 55 to 65 was dollar indexed, the Naira indexation 35 to 40, the 0 to 5 in terms of diesel indexation, that's more ATC. Previously with IHS, that number would have been 0, but when you blend IHS and ATC, the number looks more like 0 to 5% on an aggregate base. But what does it look like now? So the dollar indexation, pure dollar indexation has moved now to 35 to 40. You've got a slightly larger component of Naira and then the Naira diesel in terms of the kind of blended average. And this is both IHS and ATC. We're moving to space and power. The power is indexed to the Naira diesel indexation, and then the space is again completely to Naira. So it's giving us a much healthier, from our perspective, mix of dollars versus Naira. And when we look at the financial effects, again, these are pro forma illustrative views. So at the EBITDA margin level, 9 months, on a 9-month view, it has a benefit of 3 to 4 percentage points in Nigeria. If you annualize it and keep it very simple, the math, 9 months and annualize it to a full 12 months, there are obviously seasonality effects here. So we're just keeping the math simple here. So you'll be looking at somewhere between 4 to 5. The cash flow, we look at it, obviously it's in Naira payments, 9 months, 75 billion to 85, annualized 100. And the sensitivity, you well remember the sensitivity was more like 1.3 for every 10 percentage points, because as you saw with the last slide, the clear dollar component has reduced. So you're seeing a slightly more muted impact on sensitivity Naira. And obviously this is off a base of around 1,500 odd Naira to the USD. So the sensitivity is somewhere between 0.5 percentage point and 1%. As I mentioned, and I'll say it for the third and final time, of these agreements are confidential. You guys would like to ask us a lot of questions. What we will do with our Q3 release of Nigeria results is to go through it in extensive detail where the P&L effects, I'm talking about EBITDA, but you want to work this thing through all the way to PAT. There's quite a bit that happens at finance cost as an example. So we will do that with the release of the Nigeria results at the end of October to work through the P&L effects, also the balance sheet and cash flow effects. So this should give you some framing of why we see that renegotiation as having been successful. The negotiation, this tower renegotiation of the leases is not a silver bullet to solve the negative equity position. The big issue that we continue to engage on is really around tariff increase, and I'll talk about this a little bit later. Moving on from Nigeria, markets, we've seen very pleasing growth in the SIA business, headed up by Yolanda. We've seen very good growth on data and fintech. Uganda continues to be a very strong business all around. You saw the top line growth, very strong cash generation, stable margin, from that business. Rwanda dealing with some regulatory challenges around mobile termination rates, and that's impacted us, on the connectivity side, the fintech side within Rwanda growing very strongly and healthy. And as we always say, SIA is the business where we see the potential of fintech more generally. 29% of service revenue is coming, total service revenue for SIA is actually coming out of the fintech. On the Weka side, again, also pleasing growth for both data and fintech, revenue. Ghana's results you'll have seen, but very pleasing growth on data revenue, 55%, fintech 38%. We had a price ups on data that's helped sustain the healthy data revenue here, and the fintech business continues to grow very strongly. Cameroon, solid set of results. Some competitive challenges we've seen and regulatory challenges, particularly around the ability for CVM in Cote d'Ivoire there. But again, fintech showing a healthy contribution of 20%. MENA has been a story really around Sudan, as I mentioned earlier on, where the performance has been impacted by the ongoing conflict and actually our network being off air for a considerable amount of time. As I mentioned, we've exited now Afghanistan. We have 2 months of numbers of Afghanistan in the half, but that, we've concluded the orderly exit. The joint venture in Iransal continues to grow quite strongly, growing 82%. Given US sanctions, we still have money trapped there, about 3 billion rand of accumulated dividends at current exchange rates still there. And Snap, the so-called Uber of the Middle East there, is still growing at a very healthy clip at 4.6 million daily rides. There's a big Snap ecosystem that's built around ride-hailing that is actually quite impressive within that market. On fintech, again, talking about what's giving us confidence around the system ecosystem expansion. As I mentioned, strong transaction volume growth. You see the bank tech loan value growing just under 53%. Payment and e-commerce, I mentioned the merchants, gross merchandise value up 20.2%. Remittances, opening up new remittance corridors, and that's up just under 27% in the period, 573, 77 inbound corridors that we now have access to. And remittance is a big opportunity that we're obviously looking to leverage, over time. Before I pass on to Tsulu, I'll come back with outlook and priorities. Just, kind of marking our own homework in terms of the half against our medium-term guidance. The 12.1, we still think it's an amber because of the underlying issues that I spoke to and which Tsulu will explain when you look at it ex-Sudan as well as the Nigeria translation. South Africa, as I mentioned, a tale of two halves, 3% in Q1, 3.6. So we saw an acceleration in service revenue in the second half of the year and pretty much, good progress around asset realization, and Tsulu will take us through the ROE. I'll pause here and ask Tsulu to come and take us through the financials, and I'll come back with outlook and priorities.
Thank you very much, Ralph. A very good afternoon to everyone that is joining us today. Ralph has shared with you the operating context under which we have been operated, the macro context under which we have operated. And I'm really pleased to share with you, the resilience of our financial performance under these tough circumstances. But before I do that, I think it is important to just really highlight some of the significant items that impacted our results. And as you can see from a macro perspective, firstly, the sharp devaluation of the Naira resulted in a higher operating cost by 3.2 billion, as well as the FX losses of 13.8 billion coming through on our finance charges line. In total, we had about 16.2 billion rand from a group perspective on these FX losses. We also had the effects of the foreign exchange translation impacts on our reported currency results in this regard, based on a number of key subsidiaries, in particular Nigeria. The translation effects reduced our bottom line by about 5.6 billion rand. Secondly, in terms of the key macro impacts, we recorded losses amounting to about 300 million from MTN Sudan. As Ralph has indicated, we're still seeing some challenges from an ongoing conflict perspective. And I'll just illustrate some of these as I go along. And I think just turning into the accounting effects on the right-hand side, if you recall, we had reported previously that MTN Nigeria's results included a restatement on the interim financials of 2023, arising from the revision of FX losses, unrealized FX losses relating to IFRS 16. So at high level, the impact on group result was on profit after tax with restatement of 6.7 billion. And in terms of earnings per share, that was about 282 million, as you can see, 282 cents per share. And then in terms of the impairments that we recorded, MTN Sudan and IO Group recorded 4.2 billion in total in terms of impairment. As we've been indicating from a Sudan perspective, it was about 3.8 billion, roughly due to the continuing conflict that we are seeing. We also recorded just under 200 million, about 140 million in terms of impairment with regards to the remeasurement on the non-current assets held for sale. But we also saw a gain on disposal in terms of Afghanistan. As you recall, that we disposed of Afghanistan earlier in this year. And I think these impacts you will see coming through on our expenses, our EBITDA, as well as our headline earnings per share. Now, if we go into the details of our financial performance, starting with the salient points on the group income statement, you see that we delivered service revenue growth in constant currency of 12.1%, and on a reported basis, service revenue declined by 20.8%, and largely due to the translation impacts that we mentioned earlier. And I will unpack this in a bit more detail in the following slide. And then in terms of EBITDA before once-off, we saw a marginal decrease of 0.4% in constant currency as a result of the overall headwinds on the top line, but also upward cost pressures that we are seeing. So consequently, we reported a decline of 4.4 percentage points on our EBITDA margin, or to 36.5%. And on a reported EBITDA in absolute rand terms declined by 41%. If you move on to depreciation, you will see that on a reported basis, decreased by 7.2%, really reflecting the translation effects. But on an underlying basis, depreciation was driven by CapEx additions as well as the spectrum acquisitions. With regards to net finance charges, which include FX losses, we saw an increase in constant currency of 106%, but an increase of 3.5% year on year on a reported basis to 23 billion. And I will unpack this also in a bit more detail later on. When you look at the share of results of associate and joint ventures, you can see stellar performance with a growth of 88%. And this was really benefited from the strong contribution from Irancell, our JV, which saw a growth of 160% year on year in constant currency and about 82% in growth in constant currency. In terms of income tax expense, we saw a decline of 84%, and this was as a result of the major impact on our reported profits that declined, largely caused by the losses that we recorded in MTN Nigeria and Sudan in the main. And then the profile that you see on the interest of non-controlling shareholders was mainly due to these losses that I've also mentioned. And at bottom line, from an adjusted headline earnings per share, we saw a decline of 50%, and I will also unpack these movements later on in a different slide. In terms of our ROE, we saw a return. We reported a return of 20%, which was a reduction of 4.2 percentage points relative to last year, which was owing to the lower earnings that I've mentioned before. Now, I think it's important, before I get into the service revenue bearers of our business, just to unpack the vertical, just to unpack and take you through on this slide some of the illustrative view of our service revenue if we adjust for these significant items that have impacted on our results. In particular, these include the Sudan conflict as well as the hyperinflationary impacts in South Sudan as well as Ghana, but we also reflect here the impacts of the devaluation of the currencies, most currencies against the ZAR, which is our reporting currency, and most significantly the devaluation of the Naira. So you can see that the major call out here is actually the translation impacts of about 38 billion rand, of which Nigeria makes up about 36.5 billion, really reflecting the Naira depreciation against the ZAR, which was on average about 181% year on year. So if you really aggregate these significant impacts, they had about 38.9 percentage points impact on our service revenue growth, which was really a decline of 20.8% that I mentioned on a reported basis. So the slide demonstrates that had these headwinds not materialized, the service revenue would have been at around 18% year on year. If I can then move on to our group service revenue bearers, as you can see from a voice perspective, we continued to see, we've seen a decline of 0.4%, largely impacted by voice substitution in South Africa. We also saw from an Ivory Coast perspective being affected by the cable cuts that took place in the first quarter of this year, but also Ivory Coast is faced with intensifying competition as well as some regulatory headwinds. Some disruptive competitive pressure also were experienced in Benin and Rwanda in the main. Now, if you look at our data, you will see that it is the largest contributor to group service revenue with a growth of 21%, really driven by strong data traffic growth in our markets, again also underpinned by the continued investment that we're making on our network. FinTech continued its strong growth momentum with service revenue growth of 27%, which is in line with the medium-term target. You would recall that we have now revised the medium-term target on FinTech service revenue to a high 20s to low 30s range. Other, which includes SMS, enterprise, and ICT, also showed good growth, mainly coming from Nigeria and SA, and I will share that also later. Overall, if we excluded MTN Sudan, the group delivery on service revenue would have been 13.6% in constant currency. Now, if I can just briefly touch on the performance of SA and Nigeria, our two large markets, and just starting with South Africa, it delivered service revenue growth of 3.3% year on year, really continuing to navigate a challenging macroeconomic environment. So where did this revenue come from? Largely came from data revenue, which rose by 2.4% year on year. We saw a good growth as well from FinTech of about 59%, driven mainly by airtime advances, but also the expansion of FinTech offerings through targeted initiatives. As I indicated, South Africa also delivered very good growth on enterprise in terms of bulk SMS and ICT, largely from main deals, a growth of 26% year on year. The growth in these service revenue bearers were, however, offset by the decline in voice of about 6.1%, although reflecting continued improvement in the overall trend during this period. And this outcome was also underpinned by the continued improvement in our network availability, as well as MTN SA's commercial initiatives. If we can just look at the expenses from South Africa, you'll see that the growth year on year was 4.4%, with cost of sales growing by 7.4%. And this was largely driven by devices and commissions as they continue to drive channel expansion. Operating expenditure was very well managed during the period, with a growth of just 0.6% year-on-year. And this really enabled them to expand their margin with EBITDA growth of 4.3%, excluding the once-off gain on disposal of SA Tower. In this performance, however, as we've indicated, there is the benefit of the sale from the sale of the insurance receivables amounting to just over 200 million, which is reported in other income. Excluding this benefit, the EBITDA would have increased by 2% with a margin of 35.7%. However, South Africa did continue to execute on the expense efficiency program, realizing a saving of about 500 million during the period. If I move on to Nigeria, and as we indicated, I won't dwell over Nigeria. Most of you will have seen the results coming from Nigeria on the 30th of July. Nigeria delivered strong performance with service revenue growth of 32.4% in constant currency, in line with the prevailing inflation in Nigeria, as well as in line with their medium-term target. The result was supported by strong performance from most of their service revenue bearers. Very briefly, we saw voice growing by 12% in Nigeria, mainly on base growth, but also higher usage driven by continued CVM initiatives. We saw data very, very strong, also growing by 55%, boosted by data bundle revamps as well as optimization. Again, good growth from enterprise, which grew by 27%. If you look at the expenses, these were up 82% in constant currency. And within that mix, cost of sales grew by 34%, growing slightly above inflation and service revenue. However, impacted by the Naira devaluation was a significant increase on the operating expenses, which went up 107% year-on-year, really impacted by the network expenses. And other drivers of higher OPEX was mainly the introduction of the VAT on tower leases, which was introduced in the last quarter last year, as well as elevated CPI adjustment on lease rentals and higher energy costs. So as a result of these higher operating expenses, growing faster than the revenue, the EBITDA margin declined by 17.4 percentage points to now 35.7. So if we had to adjust for these combined effects of Forex with an impact of 15.3 percentage points, as well as the VAT on the tower leases with an impact of about 2.7 percentage points, the EBITDA margin would have been at about 54%. In terms of capital expenditure, MTN Nigeria spent 1.9 billion, and this was with a capex intensity of 9.4%, and this is 9.4%, and this is excluding leases. As we communicated previously, MTN Nigeria did streamline their capex plan in order to manage the cash flows, but more importantly as well, enable them to accelerate the settlement of the dollar-denominated obligation. So this exposure, they were able to reduce quite significantly since December, from about $417 million to now about around $100 million. So when you look at the Nigeria performance overall, they delivered solid underlying performance despite a very challenging macro environment. If we can move on to fintech, you saw fintech grew by 27% in the period as we continued to scale up our mobile financial services, withdrawals and transfer services, which still make up the bulk of the contribution to group service revenue, grew by 20% and 22% respectively. Very pleasing is the growth that we're seeing on advanced services, which rose by about 58%, really coming from payments and e-commerce, which grew by 37% in the period. Bank tech and remittance, although still nascent, growing by 73 as well as 39% respectively. So as you can see on the right-hand side, basic services to still contribute meaningfully to group fintech service revenue, although a reduction from 62% to now 59% in terms of contribution, while advanced services contribution increased by 5 percentage points. And this aligns with our stated objective to move more towards more advanced services in terms of the revenue mix. You'll also see that the strong top-line performance was supported by the continued efficiency initiatives to really drive improvement on the EBITDA margin within our target range, which we have communicated previously as our target range of mid 30s to high 30%. If I move on to our group expenses now, just giving you a bit more detail, the total expenses grew by 20.3% to 59 billion, with group cost of sales up 12%, largely driven by the increases in commissions in our GSM, fintech, as well as digital businesses. In particular, we saw an increase in interconnect roaming cost, as well as largely due to increased traffic volumes, but also the impacts of the FX devaluations, mainly in Nigeria, had an impact on the cost of sales line. Looking at our operating expenses, you will notice that we saw an increase of 28% year on year. And the main driver of OPEX growth was really coming from our network expenses, which you can see on the right, grew by 58%, around 58%, contributing almost 18% of the total cost. Approximately 80% of the network expenses growth was driven by Nigeria due to the increased site rollout, a spike in inflation, as well as the FX devaluation impacts. In other markets, the main cost pressures varied, and mostly other coming from a higher energy cost as well. We also saw an increase on our staff cost in terms of about 11%, but this was well below our blended average inflation of about 14.1%. But the main drivers were really coming from an increase in headcount as we continue to scale up our platform businesses. Annual salary increases were really in line with inflation across all of our markets. If we can then move on to the next slide, just to indicate that it is very important for us to continue to try and cap, the headwinds that we are seeing, and we continue with our expense efficiency program. We delivered 2.4 billion rand in expense efficiencies in this period, with 35% of the savings, as you can see on the pie charts, recorded at head office, and this was followed by SA, then Worker, as well as the CR regions. By area, these savings were largely coming from network and IT, contributing 34%, staff cost optimization contributing about 31%. You will also notice that on the right-hand side, we provide a view of how our total cost as a percentage of revenue has evolved. It has increased by almost 4 percentage points since the last period, but this really reflects the pressure that we are feeling through the tough macro environment, particularly the Naira devaluation. So you'll notice that the network expenses as a percentage of revenue has increased from 13.3% to now almost 18%, while other operating expenses has slightly declined or remaining constant year on year. So this really indicates just the impacts on our network cost due to the macro impacts. We are continuing with our expense efficiency program, and we have communicated previously that we will deliver 7 to 8 billion rand over the 3 years from 2024 onwards. As I've indicated, we've now been able to deliver 2.4 billion rand, and those are the initiatives on the bottom right that we continue to execute on amongst others. If I can just move on to the finance cost breakdown, you will notice that our net interest was steady during the period, reflecting repayments on borrowing, mainly coming from Nigeria as well as Uganda. The average cost of borrowing has gone up to 12.8% from 10.8%, and this is mainly as a result of the higher interest rate environment across most of our markets. The decline in finance lease costs to 3.3 billion was largely due to the translation effects. So net finance costs on an underlying basis, including leases, decreased to 6.7 billion from 7.4 billion last year. The big call out on this slide is the FX losses, which amounted to 16.2 billion, as I indicated, of which 13.7 billion rand of that on your right-hand side came from Nigeria. There were some FX losses at head office, and these were largely due to FX impacts from cash upstreaming, mainly from Ghana, as well as Nigeria. If I can move on to our adjusted headline earnings per share, firstly, a reminder that the 2023 figures had been restated as a result of the FX-related restatements in Nigeria that I mentioned earlier. So on this basis, you'll see that our attributable earnings per share moved into a loss of 409 cents, reflecting the lower earnings that I mentioned earlier. This outcome was also impacted by the impairment of assets and losses on remeasurement of the disposal groups, totaling about 153 cents. After adjusting for these items, our reported headline earnings was a loss of 256 cents. The main impact on basic headline earnings came from hyperinflationary impacts, about 57 cents per share, as well as FX losses totaling 519 cents per share, of which 389 cents of that came from the Naira devaluation during the period. So if we adjust for these non-operating items, non-operational items, you'll notice that adjusted headline earnings was down 50% to 337 cents. So I think it's important on the next slide just to highlight these translation effects that mainly affected our headline earnings per share, adjusted headline earnings per share, by 50%, as I mentioned. So circling back to the factors impacting our financial results, this analysis illustrates it at headline earnings per share level. You'd recall that I showed you a similar slide on service revenue analysis earlier. So similarly, this slide shows the outcome if we were to adjust for the effects of Sudan impairment, the effects of Sudan performance, the FX impacts on our cost, in particular in Nigeria, as well as the translation effects of translating into our reporting currency, the South African rand. So on this basis, adjusted headline earnings would have been 789 cents per share versus the 373 cents that you are seeing. So this represents a growth of 6.9% versus the prior year. So again, the biggest impact, as you can see, is the FX devaluation in our key markets against the ZAR, with Naira being the most significant from the devaluation. So 310 cents, of which the 283 cents per share came from Nigeria. If I can just move on to our capital expenditure, briefly, we capitalized 13.4 billion, excluding leases, with capex intensity of about 15%. And this is in the range that we target of between 15 and 18%. By market, you will see on the right-hand side that 34% came from South Africa, as they completed their comprehensive network resilience plan. 14% came from Nigeria, as I did mention that there was some streamlining of capital expenditure in Nigeria as they continued to work through their dollar obligations. A combined 47% of our capex was deployed from other markets, SIA and WECA, in line with our capital allocation framework as we continue to invest in faster growth areas. By type, you will see that we spent about 74% in terms of investment in networks, and then IT was mainly about 26%, which is really also to support the scaling up of our platform businesses. Just to touch on our free cash flow analysis, and maybe to note that we have evolved our disclosure on this slide to better show the free cash flow analysis rather than the accounting cash flow recon that we used to provide. So from the waterfall, you can see that our operating free cash flow declined by about 56% year on year to around 10 billion. This mainly reflects the pressure on our earnings. As you can see, our reported EBITDA at 29.9 billion rand relative to what we had last year. Working capital also had an impact with outflows of 7.4 billion, and in the main, this was largely due to trade receivables in various markets, various parts of the business due to some economic pressure in some of the markets. There were also the prepayments to vendors to try and mitigate the FX volatility. We also saw some offsets in terms of working capital from trade receivables, mainly coming from Nigeria, as they continue to manage the availability of FX liquidity. We also made payments for leases, 3.8 billion rand, and then in terms of capital expenditure payments, 14 billion rand, and this is before the payments for spectrum and licenses of 777 billion, which was a lot lower than the payments we made last year. So after we've made payments for interest, net interest, as well as taxes of 5.7 as well as 5.8 billion rand, there was a net flow in terms of free cash flow of about 2.4 billion rand. So I said a bit of short-term pressure in terms of our cash flow profile. We are fully focused on initiatives to navigate the current headwinds that we are seeing and to deliver on our ambitions. And Ralph will be wrapping up and giving you just a view on some of the initiatives that we are looking at overall. If I move on to our leverage and liquidity profile before I hand back to Ralph, as you can see, despite the short-term pressure on free cash flow, our balance sheet remains strong, with group net debt to EBITDA ratio of 0.8 times, which is well within our covenant limits of 2.5 times. The slight regression in this ratio was due to softer EBITDA, as I've outlined earlier on. Our holdco leverage is now at 1.6 times, which is really broadly in line with our medium-term target. Yes, our medium-term target is 1.5 times, and we are pleased that we have been able to maintain this given the flux of our macro environment. In terms of the underlying drivers of our holdco leverage, it was negatively impacted by reduced cash balances, given the dynamics I've explained earlier on. You'll also recall that we made a dividend distribution relating to 2023 in the first month, early in the second quarter, totaling about 6.2 billion rand. Our currency mix has assisted us in minimizing the impacts of FX on our holdco leverage. As Ralph said, we're now at 22%, which is well below our targeted mix that we target of about 40%. Our holdco liquidity headroom also remains very healthy at 30.4 billion, with 11.5 billion rand of cash balances, and the balance of 18.9 billion coming from undrawn and committed facilities. We must say that the debt market remains supportive to the group. We have been successful in refinancing some of our maturities under the DMTN program, as well as our banking facilities. And we do remain committed in terms of early settlement of our dollar-denominated debt. We upstream gross cash of about 6.5 billion, as you can see, from various opcos as well during the period. And over and above that, as indicated, we have received proceeds from Ghana and Uganda in terms of localization, about 1.7 billion. So overall, we do believe that our balance sheet is in a very good shape, underpinned by the continued discipline in our capital allocation framework. And this really enabled us to navigate this current and macro environment and to support the execution of our strategy. Ladies and gentlemen, thank you very much. I now hand over to Ralph.
Thanks very much, Tulu. Taking the stakeholders through our financial performance and giving you both the underlying performance as well as the reported results. As I said up front, that I think our underlying performance and the momentum is very encouraging for us, but we have had to deal with the impact of the shock of the Naira devaluation, as well as the impacts of Sudan. So before we go to Q&A, maybe a final couple of closing points. The outlook. I think the operating environment we've been in the last couple of quarters has been really driven by global macro conditions and how they've translated into our region and specifically into our markets. And we've seen quite a lot of currency movements, which you see in our results, inflation elevating and actually growth being a lot more lackluster than people had anticipated. We're kind of looking forward and using sources that we believe are credible. So most of our data sources we use, I'm sure you all use your own models. We leverage IMF data sets. We often use Standard Bank Group securities. They generally tend to be, on average, more accurate. They have people on the ground, and they actually, we tend to see their forecasts more, closer to reality. So we have a blended view on what's here. And I think you can well imagine that when we plan more conservatively than what you see here, just to make sure that if there are any shocks, we can actually absorb them. But I think the big main kind of global trends is, if you look at developing markets, is almost the peaking of inflation and the trend towards lower inflation and the rate cutting cycle when you look at discussions in Europe and the US. That trend, we believe, will come into our markets. I think when you listen to commentary around where the SARB is going to in South Africa, it gives you that sense that there is beginning to be a sense that inflation has somewhat peaked and we should start to see rate cutting coming across. GDP growth, is seen as likely in the medium term to start accelerating, particularly on the back of inflation coming through. And there are many views on currencies there that, these are Standard Bank Group securities view on closing exchange rates for the year. We plan a bit more cautiously than what you see here. But I think it's more about the trend than the absolute number, which is suggesting that actually we should start to see an easing of some of the headwinds. And so the strong underlying performance that we have should start coming back in the periods ahead into the reported results. So within that context of near-term continue some challenges, but beginning to see some moderation on inflation, interest rates, and so forth, what are our priorities for this year? The priorities we have are pretty much the same priorities we announced in March, and we continue to execute on those. Some of them we can tick the box and say we've completed. We finished the network resilience. We remain on guard if I think we see a reversal of the national grid. What we know is if the national grid comes back to levels pre-Q2, at stage 6 load shedding, our network, given the investment in resilience, would be up by over 95%, given the mix of backup power that we have. So yes, we're happy with the situation with Eskom, but if that, for whatever reason, deteriorated, the network actually is resilient and we've invested sufficiently. So as I mentioned earlier on, prepaid will be the focus, for much of what Charleston team will be doing, and we'll continue to work on those 5 action points in Nigeria. There's no silver bullet of one of them. We need the combination of all of these to come through. A movement of 100 naira, either up or down, is exceptionally sensitive all the way to PAT. And I think many of you would ask us, how do you see? There are many moving parts, and I think it would be irresponsible for us to tell you, we think, this is the single set of actions that will get us back to negative, to resolve the negative equity. We've got to work on all of them, including continue the discussions really around the tariff increase, with the authorities. And I think it's pressure not just only on us in Nigeria. You see it in Airtel's results, you see it in IHS's results, to sustain sufficient capital investment to support the network and the significant growth. We believe that ultimately we'll find ourselves with the authorities around that. In terms of the platform strategy, continue to execute. We've spoken about issuance and acceptance, the 7 initiatives. We'll see these coming through Q4 into early parts of next year as we get traction in markets such as Rwanda, Uganda, Ghana, Nigeria, and as well as Cote d'Ivoire, that we're continuing to progress. The focus on expense efficiencies remains. As Tulu said, we've made good progress, but we've still got to get all the way up to the 8 billion, and we're not going to pull back on that. Towerco contracts, we've pretty much renegotiated all our tower contracts with IHS into 2030, into the next decade. So with IHS, we've done Rwanda, Zambia, Cameroon, Cote d'Ivoire, South Africa, and Nigeria. So that set of contracts into the next decade have been completed, and we have our other towerco partners. They're not as big in our lives as IHS, but with ATC, we've also closed out in Nigeria, and we have ATC also in our footprint here in South Africa. Cash upstreaming, we continue that focus. On the debt profile, as Tulu said, our capital allocation framework has managing the dollar exposures as priority number 2. Priority number 1 is investing in organic growth, which we'll continue to. We've set out and communicated again that although we've capitalized 13 billion, we still anticipate for full year to be in the 28 to 33 billion corridor of capex investments to support the growth that we see in the network and ensure that our business is in a strong position as we navigate and exit some of the much more pronounced headwinds that we've experienced in the last period. We have a stub of 2024 bonds, about 1.8 billion rand equivalent, which we will settle as that stub matures in November. And the only bit of dollar debt that we'll have to deal with is the 2026. So again, good progress there. And so these are the initiatives that will continue to focus on executing to ensure that the commercial and underlying momentum that we see in the business is maintained. We continue to share this graph, which gives us the confidence and view that the structural growth opportunity for data and fintech services remains. We started showing this graph post-COVID to show that this was not just a COVID dynamic. In our markets where the internet connectivity is still relatively nascent and financial services not as ubiquitous, we think that there is long-term growth that is evidenced by the kind of sequential growth that we continue to see in data traffic and fintech transaction volume. And we need to be able to, for our shareholders, to show that we can monetize this kind of growth that is quite unique to this continent as one looks at it and compares with other jurisdictions. As I mentioned early on in my introductory remarks, the 6th important point was reconfirming the guidance. We are confirming the guidance that we've set out. Nothing has changed. We're still using the capital allocation framework, the same batting order that we've always had. From time to time, we get questions from our shareholders. At current share prices, don't you want to do a buyback now? It sends a message to investors that you believe the share is undervalued. We're saying we've taken those messages in, we've debated them with our advisors, we've debated them with our board, and we feel the right allocation of capital is to the growth opportunity that we believe is structural and will continue to come through. So we're keeping our batting order of capital allocation pretty much the same, and I think you'll see share buybacks and specials right at the bottom of that list of top 5. And our focus is investing in networks and platforms, paying down the debt, and then the dividend, which we are saying for FY 2024, the 330 cents, the board anticipates we'll be able to meet that. And that's also within a capex envelope of the 28 to 33 billion for FY 2024. Ladies and gentlemen, that ends the presentation from Tsulu and myself. We do have Charles and Dino in the room, so they can take the heavy questions on South Africa. Just give Tsulu and I an opportunity to pass on some of the load. But happy, I'd ask Tsulu to come onto stage. I think Tato also needs to come onto the stage. Charles and Dino can stay seated in their lovely couches.
Thanks so much, Ralph and Tsulu, for the overview. I think important to go through quite a lot of important stuff in terms of what's affecting our performance. We only have 10 minutes left in terms of the schedule. We will indulge an extra 5 or 10 minutes past the 5 o'clock. Just an apology in advance to those logging in on CNBC. That does have a hard stop, as we like to say, in the corridors at about 5 o'clock. So maybe let's just get into the questions. We will interact with many of you over the next few days and weeks. So you will have another opportunity to interact with Ralph and Tsulu. So maybe let's just start with, as we usually do, with questions in the room, and then we can get into the online platforms.
Hi everyone. I think all my questions are for Dineo and Charles on South Africa. I guess if you can, Charles, if you can touch on the SA prepaid recovery. Just struggling to find where your customer value proposition is versus your peers. Your peers are seeing a nice recovery in prepaid, but you are not necessarily seeing as big of a recovery. What needs to happen on prepaid, and what will you entice us with over the next 6 months? And then I guess on your pricing gap versus Telkom and Cell C, if you can comment on that, how has that evolved over the last few years? And then on Ambition 2025 EBITDA margin guidance, please can you remind me of that guidance? I think the last time we had about 37 to 39%. But that obviously was during load shedding, and yeah, like what should the margin, how should the margins evolve beyond that? Thanks.
Charles is sitting in the front here.
Yeah, thank you so much. Thank you so much, Luisa. I think on the prepaid recovery, we put the price increases only in June and then go into July. And most of the price increases went into our internal channels. We expect that it will filter into the external channels, let's say July and then August. You can expect to see, a relatively recovering prepaid performance, let's say towards September, then into Q4. So we are comfortable that in terms of where we are, we're actually mark to market in terms of pricing. I mean, I think in prepaid, to be honest, the propositions are practically the same. So I guess in the end, I think it will filter through in terms of our performance as well. You also asked the question around Telkom and Cell C. I want to check, is this on wholesale or is this on consumer? No, look, I mean, we mark ourselves largely against VC, if I could be honest. I think if you check our prices, we're largely comparable compared to Vodacom. We did the price increases more for more concept on some propositions. Some propositions, we went straight out and increased the ERM. So, that's really our benchmark, I think, in terms of pricing, largely around the main competitor. And then in terms of the margin, I mean, we're still giving the push of 37 to 39. We have a very tough H2. I mean, it's a proper hockey stick coming through in H2. That's why I was saying H2 will be slightly tougher, but we still remain, focused on the guidance that we've given. Thanks.
Hi everyone, it's Shannon from Nedbank. I'll split the questions around, so one for Tsulu, one for Charles, and one for Ralph. Tsulu, first for you. You didn't mention my favorite West African opco from upstreaming, so just wanted to check if you did get anything out of Nigeria and at what rate, and obviously contrary to that, if you didn't, why, considering FX liquidity has improved quite considerably. One for Charles. Your data subs grew 10%, your traffic was up 35%, but your revenue was only up 2.4%. And I compare that to Nigeria, where traffic was up 42%, users were up 10%, but they grew revenue 56%. So you're giving a lot more for a lot less is what I'm thinking, but just some clarity there. And then on a question for you, Ralph, on Zakhele Futhi, just some rationale behind extending that deal. My take is that, the dividends were quite weak over the last few years. So is there a sense of a sizable liability there in that Zakhele Futhi structure, which hasn't been cleared by the dividend? And, by your forecast, the 3-year extension, is that the thinking behind that? Thanks.
So?
Yeah, so in terms of cash upstreaming from Nigeria, we have cleared the interim 2023 dividend. I think, as you know, there was no dividend declared for 2020 financial year ending 2023, the full year dividend, because of the negative equity. But the interim dividend was cleared, and we have been able to upstream that. It is in the 6.5 billion, as we've indicated.
Charles?
Yeah. And Pressure, I think it's a good call. But let me lead by saying that come Q4, we should start to see a better year-on-year data performance from South Africa, because we did mention in Q1 that we have this clawback on the extra time that we are doing that's affecting the data performance. So that's just to start on data performance. On the traffic profiling, you're right. ADS is strong, revenue is 2.4%, and data is growing at 35 or so%. So you're right. But let me unpack that a little bit. So if you segment the usage, you will see that the mobile traffic, let's talk about prepaid to be specific, is about only 9% increase in data traffic on prepaid. So that is slightly aligned with the revenue performance overall. Where we have pressure is on the FWA traffic profile. We grew the proposition of home quite aggressively. And I think the reason really was just to build the home base. We think we've done a fantastic job so far. And I think what we're going forward, we'll try to optimize and find a way to make sure that the usage, does not exceed the plan. So think of it that way. Data should grow, let's say, into Q4 on the prepaid side as well. But then FWA, which is the biggest contributor of the traffic growth, we'll try and manage that properly going forward. But we really were deliberate because we wanted to actually get a bit of share in terms of fixed wireless access. Thanks.
Yeah, on the question on Zakhele Futhi, we've been in discussions between the MTN group board and Zakhele board around the unwind, which is coming in or scheduled for November of this year for the 8th year. On reflecting on where the scheme is, and also referencing the very sharp, unique devaluation of the Naira at this particular point in time, the discussion was we should actually think about extending it for another 3 years. Now, the detail of that extension will be communicated, as part of the EGM. But what the Zakhele Futhi board will have is the right to, to unwind any time in that period. They will have that election ability to, to unwind in that time. So having taken cognizance of the fact that Zakhele Futhi has been a very strong underpin to our empowerment credentials, a very sharp devaluation of the Naira, you've seen what's happened there, not to guarantee a positive return, but it is a very sharp and sudden, and applying of our minds of both boards was the 2 to 3 year extension, should be reasonable. It doesn't cost the shareholders too much. There is an NVF backlog that needs clearing there. Does that give it the ability to clear in the next 2 to 3 years? Those are some of the discussions that we've had between the two boards and that'll be put forward to the EGM in October.
Thanks, Ralph. Maybe just check if there's another question in the house before I go to the online platform.
Just a quick question for Charles, please. I just wanted to, now that the resilience spending in your CapEx line has passed, what does CapEx spend in South Africa look like for the rest of 2024? Thank you.
Yeah, we remain on the current CapEx profile. I think we are just around, let's say, about 9 odd billion. Yeah, 9.7 billion rand in terms of CapEx. The envelope doesn't change, so I think the biggest thing will be how do you navigate the CapEx profile going to 2025. But for 2024, we remain on the current envelope.
Thank you. Let me just take a couple of questions from the online platforms. We'll start with Nigeria. Will Nigeria be subject to a minimum applicable tax, to the minimum applicable tax laws while it is loss-making? What impact do the tower contract renegotiations have on MTN's negative equity position, i.e., could you provide a timeline for resolving the negative equity? And what do you perceive as sustainable margins in Nigeria?
Yeah, maybe just
you take the tax ones.
Yeah, on the first one, there is a minimum tax, even when you make losses. I think it's about 0.5% of total turnover. Yeah.
Yeah, look, in terms of the negative equity, I think to communicate that this is what we think, I think it would be irresponsible. There are many factors that move that number. As I said, a 100 Naira movement is quite significant all the way to PAT. And that's just the Naira. Then you've got to look at CPI. So there are a variety of forces, and we hope that even at the margin level, we've given you the guidance that says 10% movement either way at the margin level is 0.5% to 1%. The items below EBITDA, finance cost line, that will move with the tenure of the lease liabilities having been increased to 2032 and so forth. And so those, play a role. The big thing that needs to come in is a decent tariff increase. And it's no silver bullet. You need a combination of all those factors. So we'll have to progressively work through all these 5 actions to ultimately get there. We don't see any single silver bullet in the near term. But if you think inflation will come down, if you think that the rates will stabilize, because a lot of that FX is the IS-21 application on FX movements. It's the movement between the FX. If it's stable, that FX delta is obviously small, and it doesn't have such a profound impact on your unrealized losses. So there are just too many factors there to be able to say to you, there's this very simple answer. I mean, in terms of margins, the other issue is we've taken an approach which we look to in terms of applying IFRS 16 to try and mimic economic reality. There's an expedient approach of everything going below EBITDA. So your EBITDA margins look high because you're actually taking no FX above EBITDA, and all your movements are in below EBITDA. So again, when you're comparing the businesses, don't just look at the EBITDA. Everything is caught at the PAT level. And I think more increasingly, you'll need to look at what are the PAT margins of a company rather than just the EBITDA margins, because there's a lot of movement between EBITDA and at the PAT level.
Thanks. Well, maybe just the last couple of questions. I'm just trying to navigate those that have been answered. A combination here. This is the first one on SA. Please quantify the ICT once-off in South Africa, what kind of EBITDA contribution this had. And then on Nigeria, how much headroom do you have left in Nigeria to optimize pricing in terms of the lack of price hikes so far?
Yeah, the SA ICT, I think we have a project with GBN. There's probably around total revenue that we took, I think around 80 million or so. I won't talk more into margin, but margin was slightly tight. These are normal ICT business, very difficult in terms of margin profile. So you can think top line 80 million and in a very muted margin completely. Thanks.
Yeah, on the Nigeria side, I mean, the growth that you're seeing 50 plus, obviously there's usage, but we did have bundle optimization, which we effected in October last year. And that gave us a blended level of increase, which we're still benefiting from in the current reported period. I mean, I guess if we don't get the tariff increase progressed, I mean, we'll have to talk to the authorities and regulators really around kind of bundle optimization, which we effected in October. I mean, these discussions are ongoing.
And then just a question on Nigeria. Please, could you provide some color on where lenders and the NGX and other stakeholders sit with respect to upstreaming of cash from Nigeria when you still face a negative equity position? So I think it's asking you, can you upstream? And how much cash? I think that was answered already. So
yeah, I think we've answered the question. I mean, Nigeria can't declare dividend while they're in negative equity, and all the dividends have been upstreamed now. Yeah.
And then maybe just the final question, perhaps a follow-up on the earlier question, just on CapEx. Having spent about 4.6 billion on network resilience, is there a possibility that this investment would be subject to write-offs or amortization, given obviously ongoing reduced load shedding, or is it too early to proclaim the end of load shedding?
It's too early to proclaim the end of load shedding. I think we've answered that.
Cool. I mean, I think we can wrap it up on that point, and we will interact with you, as I said, in the coming days and months. Just a reminder that we did tease a tour of the Innovation Lab. Those of you interested, if you could congregate towards the bottom right in the room. But otherwise, we are available to answer any further questions. Ralph, I think you've done your wrap-up, but if you've got any further ones. Brilliant. Thank you very much to everyone and everyone who's logged in online. Thank you.
Thanks. Much appreciated.